I'm very fascinated with the flows because it's a trend, right, that we just cannot fight. Let me just show you this chart real quick, where the unrelenting bullish actors of quant and CTAs, specifically just the positioning with hedge funds as well, concentration risk. It still hasn't, it's just not done. We've had a few little gyrations, but the trend is still chasing calls on the upside, and the selling of put, the buying of calls, and it continues, long story short. So without a macro trigger to disrupt this, we can go higher. There's nothing that says we can't. And so far in this big, wide, crazy Ivan that we've had in the past month plus of really a 200-point range, we still are getting bought I'm talking in SPY and NASDAQ specifically, not Russell. That definitely looks a little bit different, but we're still getting that buy the dip mentality. So at what point would you see this positioning kind of, now that it is clearly very extended, and we've talked about the charts, where do you see this kind of in a de-risking mode coming into play? What's going to prompt this really from the reversal?
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Look, like we've talked about, there are certain times of year, there are certain times of the month where these things matter more than others, and that has to do with expiries and the buyback of these positions. And so, as Jem Carson likes to say, the window of weakness is open after expiry for a 2-week period, and then that increases the probabilities that macro events can become disruptive and can force some of the systematic flows to flip the other way, CTAs to sell, vol control funds to sell, because macro data kind of goes along with that. And then as we approach expiry, it just becomes harder because you have all the dealer buyback and the elimination of these positions. And so, I think here we're in a position now as we transition through this week where the macro, the flows, the supportive flows are going to be much reduced now. We're through year end, it's a fresh calendar. Now we're through this January situation, so we're raising the odds now that other things can matter. And the other things that matter are the cross asset volatility stuff and the overall liquidity that comes from global treasuries and global central banks. And after a significant loosening of financial conditions that we saw in November and December, that ultimately have now led to a reacceleration of inflation expectations higher, break-even yields higher, and the Fed having, various members from the Fed coming out and saying financial conditions loosening like this is self-defeating. We're not going to be giving you market, as much in the way of stimulus and rate cuts as you think. And the data comes in better than expected because there is a reflexive reaction to that loosening of conditions. Look at housing starts, right? Look at mortgage applications. How they've been ripping because rates have come down and wealth has gone back up again. So there is, the financial conditions moving like this does have an impact on the economy. Makes it harder to get back to 2% inflation, means the Fed needs to be tighter for longer, which is the exact opposite of what the market is pricing in now, when it is pricing in a rate cutting cycle beginning in March and a rate cut every meeting for the rest of the year. When Waller comes out and says, it's probably not going to be March and we're probably not going to cut a lot, and it doesn't look like the prior cutting cycles, at some point, the market will have to listen, particularly if the data continues to come in that way. So I think we are here. I think we are here between now and, let's say, the March expiry is the highest probability that this dynamic of economy not slow enough, inflation not low enough to support easing plays out. And so that is something I think can overwhelm the flows and the daily buying of SPY calls, right? Because what we are finally starting to see is vol becoming unpinned on the margin, not just the daily. If you look at fixed strike vol 2 weeks out, 4 weeks out, 6 weeks out, 8 weeks out, it's stopped going down. It's starting to move higher. It's not, it's not as high as it probably should be, but it's starting. That VIX print we saw earlier in the week, or maybe it was last week, 250,000 VIX call Friday, 250,000 VIX calls. Apparently, was the biggest VIX trade ever at CBOE. It's for February expiry. So yeah, that chart you showed, that's dealer positioning. Dealers are very short VIX calls. So if VIX starts to move higher, more dealers have to chase. I think we closed today, SPY right back at the 0 gamma line, maybe even in positive gamma. But tomorrow we could flip back into negative again. So look, I think we're in a position here where the potential for other things to matter is very elevated, and those other things actually are pushing against the direction of where markets are pricing, because the economy is not slow enough, inflation is not low enough, and the Fed cannot deliver on that aggressive rate cutting cycle that the market needs. And if earnings don't come through, which so far they haven't, but that doesn't mean they won't, right? We may get blowout numbers from Microsoft and Google and NVIDIA next week. It's very possible, but elsewhere, away from that big tech, banks, whether it was industrials, airlines, transports, the earnings haven't really been coming through in a great way so far. So I think if you don't have the earnings come through, you don't have the multiple expansion because the Fed can't deliver more rate cuts, you don't really have a great setup, and you don't have the systematic flows supportive because vol controls are already all in. CTAs are basically all in. Yes, you will get the buybacks back come middle of February, but between now and then, you don't really have buyback support either.
It's a good cheap hedge.
You have an opportunity here to, yes, if you're long, if you want to be long AI and secular growth, for the next 3 to 5 years, because this
or
is
even
the time,
hold it through earnings. This
is the time to be hedged. This is the time to be hedged for that.
But this is also the warning that if this, by the way, that was a $17 strike. So that was 139 million, and it was a rare kind of directional move, which also did prompt the VVIX to get excited. But if we were to squeeze, this is obviously a chart I'm showing is dealers are selling calls hand over fist. But by squeezing, I mean they would have to actually buy VIX calls at that 17 level, which could create even more delta, gamma hedging, excuse me. So that's the risk. I just still think it's a great cheap hedge. So even if like we popped up to 1521, that was working already. It kind of showed their power, but it's not necessarily a timing that we're going to get a big volatility surge. So I just wanted to kind of emphasize that.
Yep.
The market's bullish until we have a reason for it not to be. That's why we talk about all the macro risk and event risk. Okay, and then of course we touch on the flows because that just matters. And you've talked about absolutely the blackout period for the Fed this weekend. Corporate buyback blackout ends basically in a week and a half. So then we're back to markets bullish until we have a reason not to be. At the same time, underneath, there is a lot of selling going on. So the breadth breakdown in NYSE is very, very clear to me. The net selling in both NASDAQ and the Russell is a sold to you, which means the price is absolutely way divergent from the activity that's going on. I'm talking about NASDAQ. Activity of the selling that's going on underneath. Russell is more representative, so it actually has come down with the selling. So it's connected, but no, there's definitely a divergence that's forming. It's pretty large with the Qs. It'll be interesting to see how this goes, but right now it's still getting bought every dip.
Yeah, look, I think if I would look back at a checklist of things that you'd like to see if you thought the markets were going to struggle or were going to go down. One thing I'd like to see is this rollover in breadth, the 2104 indicator. And we've been looking at that indicator now collectively for the last, 5 years. And we see how that's typically an early sign as the breadth starts to decline that the market is losing some power. The second thing I'd like to see is, fixed strike vol to start bottoming and start moving higher. We're starting to get that now. We have both of those conditions have been flagged. I'd like to be kind of in one of these window of weakness periods after expiry. So the likelihood of macro overwhelming flows is elevated, increases the probability that macro will matter more than flows. So I check the box on that too. It's nice when share buybacks are not happening. So check the box on that now for another two to 3 weeks. And I'd like to be in a position where I think that the market has priced in an aggressive amount of Fed stimulus already that I don't believe is going to come. And so I'm checking the box now.
That premium that needs to be, that needs to come out.
Look, I think if, I'm checking the box on, 5 conditions I think are necessary in order to see a market come under pressure. And so I think we've really raised the odds here of potential correction coming. It doesn't mean we're crashing tomorrow or next week. It just means definitely a good time to be careful, with your longs, probably have more opportunistic shorts on, and be ready to kind of act aggressively if some of these catalysts that we're looking for play out. If next week the PCE, which is on Friday, comes in hot, you better sell risk quickly. Even tomorrow, I mean, kind of a B data point, but University of Michigan survey on sentiment and on inflation expectations is tomorrow. We've seen the University of Michigan inflation expectation reading come out in the past be very hot and cause a sell-off. So if that happens, may have to act. But certainly more importantly, next week PCE that comes in hot. That's a reason to sell. If the QRA announcement on the Monday in the afternoon shows a very big borrowing need, that suggests that tax receipts didn't come in, or spending is running hotter than expected. And so that means that the Wednesday announcement is going to be likely more duration. We could press because of that. And certainly at 8:30 on Wednesday morning, the 31st, if Yellen comes out with the duration issuance higher than expected, another reason, right? So we have some catalysts here that could really lead to a more protracted selling event we should be mindful of. And the window that it matters is open for it to matter more. So that's why, I am particularly concerned. But look,
on the flip side, the
NASDAQ made Qs that made an all-time high today. Right.
Exactly.
So I get that. And
we can still have this impulse where the dollar yen has done this not once, but twice, which have been major interventions with global central banks, US and Japan, where it gets above that 150 and they immediately come in. So that was October of 2022. That was again, just recently we had this, November 1st just happened to pull down then. So that obviously will then push dollar and yields down, or just by nature of the situation, dollar and yields continue lower. Right now, I think we're just having a kind of a counter trend bounce. But the point is, that's all equity bullish until it isn't.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.